Right now, the world of oil is a bit like a seesaw, and it's just tipped downwards. The balance that once kept prices steady has shifted, and the effects are rippling across global markets. Every movement in oil prices sends a signal, not just to traders, but to industries and governments around the world. As of late last night, Brent crude, the global oil benchmark, dropped to $62.24 a barrel for February delivery. This is a notable shift, as Brent crude is often seen as a barometer for the health of the entire oil market. West Texas Intermediate, or WTI, followed suit, settling at $58.44 a barrel. These numbers may seem small, but they represent billions of dollars in value moving in just a few hours. When both major oil markers fall together, it signals a shift that grabs the world's attention. It's a sign that something significant is happening behind the scenes, and everyone is watching closely. This dip is tied directly to a high-stakes meeting that had the world holding its breath. The outcome of these talks could influence not just oil, but the broader geopolitical landscape.
For most people, a drop of less than 1% won't change gas prices overnight. The numbers at the pump will likely stay the same for now, even as the headlines shift. But for the global economy, these small shifts are like tremors before a potential earthquake. Investors and policymakers alike are alert, watching for signs of bigger changes to come. The news of peace talks, even if difficult, was enough to make the market relax just a bit. It's a reminder that hope, even if fragile, can have a real impact on financial decisions. It suggested a future where oil might flow more freely, without the constant threat of war. Stability in one region can mean smoother operations and fewer disruptions worldwide. Still, the dip is fragile. Prices eased back, not plummeted, showing hope mixed with caution. The market is waiting to see if this calm will last, or if new storms are on the horizon. Traders reacted to the positive news, but know the situation could change in an instant. Every headline, every rumor, can send prices swinging in a new direction. The market's optimism is real, but so is its anxiety. In the world of oil, confidence and caution always go hand in hand, shaping the story of every price move.
The reason for this slight optimism in the oil markets can be traced to a single crucial meeting in Moscow. For days, rumors had swirled about a possible diplomatic breakthrough, and all eyes turned to the Russian capital as the world waited for answers. For 5 tense hours, a high-level American delegation sat down with Russian President Vladimir Putin, aiming to end the war in Ukraine. The stakes could not have been higher, with the world's attention fixed on every word and gesture exchanged behind closed doors. The world watched, hoping for a breakthrough. Newsrooms buzzed with anticipation, and millions followed live updates, hoping that this meeting might finally bring a glimmer of hope to a conflict that has dragged on for months.
When the meeting ended, the Kremlin called the talks constructive, but no compromise was reached. The official statements were carefully worded, but the underlying disappointment was clear to all observers. 5 hours of negotiation failed to produce a peace deal. The core issues remained. Exhausted diplomats left the table with little to show for their efforts, and the sense of missed opportunity hung in the air.
Having envoys like Witkoff and Kushner signaled a serious direct channel between Washington and Moscow. Their involvement underscored just how urgent and high-level these talks were, with both sides sending their most trusted negotiators. Their presence showed this was a top priority mission, but even they couldn't bridge the divide. The atmosphere in the room was tense, and despite their efforts, the gulf between the two sides proved too wide. The failure to reach an agreement sent a clear message: both sides are willing to talk, but not to make painful concessions. The documents left on the table were a stark reminder of just how much work remains to be done.
For oil markets, the talks were a mixed bag. Traders reacted instantly, weighing the potential for peace against the reality of continued uncertainty. The fact that diplomacy happened at all caused the initial dip in prices. Investors briefly hoped that a resolution might be within reach, leading to a short-lived sense of relief. But the lack of a deal means the underlying risk hasn't gone away. The market remains on edge, with volatility likely to continue as long as the conflict drags on. The brief moment of optimism was quickly tempered by the harsh reality of a failed negotiation. For now, the world must wait and see if another round of talks can succeed where this one fell short. Why couldn't negotiators find common ground? Despite numerous attempts and countless hours spent at the table, the gap between the two sides only seemed to widen. According to Kremlin advisor Yuri Ushakov, both sides laid out their positions clearly, but neither would budge. Each delegation arrived with firm red lines, unwilling to make the first move toward compromise. The main sticking point, the future of the Donbas region in eastern Ukraine, remained unresolved, casting a shadow over every discussion.
For Russia, control over Donbas is non-negotiable, a matter of national security and pride. Moscow views the region as a vital buffer and a symbol of its influence. For the US and its allies, recognizing Russian control is impossible. It would violate Ukraine's sovereignty and set a dangerous precedent for international law. This is the immovable object meeting the unstoppable force. Neither side is willing to back down, and the world watches as tensions escalate.
The Donbas is rich in resources and industry, making it a prize both sides are determined to claim. For Ukraine, losing it would be devastating, both economically and emotionally. For Russia, securing it is strategic, a way to project power and secure its borders. Because these goals are mutually exclusive, compromise seems impossible. The diplomatic stalemate only deepens mistrust on both sides.
The failure of these talks means the war, with all its costs and consequences, is set to continue for the foreseeable future. For oil markets, the risk premium, the extra cost due to war, remains, keeping prices volatile and investors on edge. The hope for a peace deal to stabilize energy flows has been dashed, at least for now, leaving global markets in a state of uncertainty. The path to peace is blocked by a disagreement neither side can see a way around, and the world is left waiting for a breakthrough that may never come.
While diplomats talked, the war in Ukraine raged on, with new dangers for the global energy market. Ukrainian forces have targeted Russian energy infrastructure, oil refineries, fuel depots, and export terminals. These attacks disrupt Russia's ability to fund its war and send ripples of fear through oil markets. Russia is a top oil producer. Any disruption can impact global prices. Even minor damage highlights the vulnerability of these facilities.
For Ukraine, it's a way to fight back. For Russia, it's a pretext for escalation. Every attack risks a major response and raises the stakes for the world. This ongoing threat keeps oil prices high, regardless of economic slowdowns. The geopolitical risk premium, the extra cost due to conflict, remains baked into every barrel. Until the attacks stop, that premium is here to stay.
In response to Ukrainian attacks, Moscow has issued a chilling new warning.
The Kremlin has threatened to strike ships belonging to countries supporting Ukraine.
This is a dramatic escalation, moving the conflict beyond military targets to international shipping. The Black Sea is a critical artery for global trade, grain, oil, and more.
If Russia targets commercial vessels, insurance rates will skyrocket, and many companies may avoid the region.
This could create a blockade, choking off vital trade routes. For oil, it raises the prospect of direct attacks on tankers, disrupting supply and risking environmental disaster.
It's a red line that could have catastrophic consequences.
This threat adds another layer of tension to an already fraught situation.
For oil traders, it's a nightmare scenario. Prices will remain highly sensitive to any escalation.
The risk of a sudden, sharp price spike is now higher than ever.
Away from the conflict, another piece of the oil puzzle was unfolding in the U.S.
The American Petroleum Institute reported U.S. crude oil stocks fell by 2.48 million barrels, much more than expected.
In oil markets, a drop in inventory is bullish. It suggests strong demand or tighter supply.
This surprise drop pushed back against falling prices.
The inventory data points to strong demand right now, even as diplomatic failure suggests long-term risk.
People are still driving, planes are flying, factories are running, energy consumption is robust.
For traders, this creates a confusing picture: bearish news from Russia, bullish news from the U.S.
That's why prices wobble instead of making a decisive move.
The market is being pulled in two directions at once. Uncertainty and volatility rule, as prices swing on every new headline.
The API report is just the opening act. The real focus is on the U.S. Energy Information Administration, or EIA.
The EIA's weekly data is the official, most comprehensive measure of U.S. energy supplies.
The EIA report covers crude, gasoline, diesel, and more, plus refinery activity and imports. This detail helps analysts understand not just how much oil is in storage, but why.
If the EIA confirms a big drop in stocks, it strengthens the bullish case for oil. If it shows a smaller drop or a surprise increase, prices could tumble.
That's why traders often wait for the EIA numbers before making big bets.
For now, the market is in suspense, waiting for the missing piece of the puzzle. The EIA report will either reinforce or upend current market sentiment. In a world driven by data, these numbers have the final say.
The recent dip was the market giving more weight to hope, but the next headline could tip the scale back. The market's direction is never certain. All these factors are weighed by traders every second, making oil prices volatile. Even without war, the balance between production and consumption is always tight. The surprise drop in US oil stockpiles signals strong demand, also pushing prices up. Moscow's threat to target commercial shipping adds a new layer of fear. On the other side, the war itself and Ukrainian attacks on Russian energy infrastructure keep prices high. A resolution in Ukraine would remove a huge risk, letting Russian oil flow more freely and lowering prices. The oil market is a delicate balancing act. On one side, peace talks, even failed ones, push prices down by hinting at a possible end to the conflict.
Where does this leave us? Oil prices are caught between faint hope for peace and the reality of war. The Moscow talks ended without a breakthrough. The conflict and risks to global energy supply remain.
The diplomatic path is for now a dead end, keeping the geopolitical fear premium in place.
Military actions and threats at sea ensure the potential for sudden supply shocks.
Any escalation could send prices soaring, overriding other market fundamentals.
Meanwhile, strong US demand is providing a solid floor under prices.
Even if the geopolitical situation resolved, robust demand would keep prices firm. The failure of peace talks means the war will grind on, keeping risk high. Ongoing military escalations could trigger a crisis at any moment. For now, a return to cheap, stable energy is unlikely as long as these powerful opposing forces remain.